Exchange. Now, a great deal of debate about the future of municipal bonds. Some say that the buying opportunity of a century is here. Others, such as banking analyst Meredith Whitney, saying investors are not getting paid nearly enough for the risk of default. She sees a muni meltdown in our future, massive defaults, as much as 100 municipalities perhaps defaulting, according to Whitney. Well, my next guest says the real risk is to be thinking right now about interest rate risk rather than credit risk. Here to explain all this, we have Jim Grant. He's the founder and editor of Grant's Interest Rate Observer. Jim, always good to have you with us.
Nice to be here.
So what about this whole idea of municipal bonds? We had the Meredith Whitney report coming out. A lot of people are worried because a lot of people depend on these things. These are retail investors. They depend on it for their income.
Well, somebody's going to be right. There will or there will not be catastrophic defaults. That is a form of stargazing. What we can see in the here and now is that these bonds yield 2, 3, 4%. Pygmy yields at a time when the Federal Reserve is telling us that it intends to create enough dollar bills to lift our prices and to restore a kind of prosperity. Now, to me, the considerations about default are beside the point of the question of risk. Are you being paid to doubt Meredith Whitney? No. I mean, say that this is the buying opportunity of a year, of a month, of a fiscal quarter, of a week, of a set. No, it's not a buying opportunity. These yields are too small to compensate you for the risk of trouble. The trouble can come in many forms, but the pure and simple fact is you are not getting paid to buy these things.
Well, indeed, in the most recent issue of Grant's Interest Rate Observer, you talk about a bear market in bonds. And so if interest rates are going to climb, anybody who's holding these municipal bonds, just the interest rate of risk alone, never mind what the municipalities are doing financially, but the interest rate risk alone will hurt you.
Well, my contention about a new bear market in bonds of perhaps generation length is itself a kind of stargazing. You know, if you look around and you say, in the past, interest rates have moved in generation length cycles. Bond yields have been falling, bond prices have been rising since the fall of 1981. Nobody now practicing, except for a few people almost as old as I am, have any idea what it's like to come in every day and expect interest rates to go up. But it has happened. It's happened at generational intervals. And it seems to me that Mr. Market, who was kind of a prankster and who loves an ironic joke, would set the scene for a new bear market with the Federal Reserve Chairman telling us about the risk of deflation. That is the setup that I think the impish Mr. Market would have. And
all right, so indeed, well, indeed, if you get this bear market in bonds, meaning interest rates are going to go up, then you don't even need massive problems in municipal finances in order to hurt the holders of muni bonds. Exactly so.
You'd just lose money every day because rates were going up. You wouldn't need the drama of defaults. And in fact, I don't know whether there'd be defaults of that scale that this very good analyst Meredith Whitney is predicting, and I dare say nobody knows. But we can observe that at these levels, at these prices, and at this persistent level of inflation, notwithstanding our debt-encumbered world, we can see that you're not really getting paid to guess.
Now, one of the things I know you're doing is you're preparing to go to London because you've got a conference that you've organized the 24th of this month taking place in London, and you've got some thoughts about the debt of the United Kingdom.
Yes,
there, too, you think that maybe it's mispriced.
I've ingratiated myself into the graces of the British establishment by condemning all of Her Majesty's sovereign obligations en masse.
Make sure you got your passport so you can get back here.
We at Grants are bearish on so-called gilt-edged securities because they are ungilded. These are pure paper obligations denominated in a currency that unfailingly has depreciated over time. They are priced, as are our municipal bonds, much too low to compensate you for the clear and present danger of monetary debasement. Ergo, we are bearish.
All right, Jim Grant, if investors are not getting paid enough to take the risk of owning municipal bonds, nor indeed are they getting paid enough to own UK gilts or UK government bonds, what should they be doing with their money?
One thought is to look at a couple of mortgage real estate investment trusts. Two that I think highly of are called Annaly, and the ticker is N as in Nancy, LY. and the other is MFA Financial, ticker simply M as in Mary, FA. Each of these, to different degrees, uses borrowed money with which to buy mortgage securities, and they live off the difference between what they pay to borrow and what these mortgage securities spin off. They differ, for example, with respect to how much they leverage. Both, by the way, are very conservatively leveraged, and they differ with the kind of assets they own. Both principally own agency-backed securities, government-backed securities.
Securities that are backed by Fannie Mae, Freddie Mac,
essentially
Ginnie Mae?
By the treasuries, treasuries imprimatur. MFA owns some non-agency securities as well. Each generates a yield in excess of 10%. Annually in the mid-teens, they earn substantial returns on equity. They have proven they are capable of navigating the rocks and shoals of our interest rate gyrations. These are, as they used to say in the day, businessman's risks. But you're getting paid to take them. Managements, I think, have proven track records of doing well in difficult times. Now, if interest rates turn against them, if the yield curve is less friendly, if short rates go up, their borrowing costs go up, you will see the share price decline. These are not without risk, on the contrary. But in contrast to munis, in contrast to these gilt securities, you are getting paid, in my opinion, for the risk. You're getting double-digit yields generated by proven managements using a measured amount of leverage. So I say, do some of that, generate that income, realize it is a calculated or businessman's risk, and stay away from the low-yielding stuff, which has plenty of risk and which pays you very little to take it.
Right, you're not getting paid to assume that risk.
Right.
Turn your attention now to just something a little bit historical. Because I know Annaly Capital as well as MFA, you talk about the risks and you talk about the short end. You talk about what happens if short-term rates increase. But in the recent edition of Grant's Interest Rate Observer, you paint a very interesting picture going back to, I think it was June of 1947. George C. Marshall at the time is the Secretary of State, and he's giving the commencement speech at Harvard, and he talks about the Marshall Plan. Well, you tell people, what were Treasury yields and what was inflation at that time?
Well, the time was not a little like ours, in that people had been watching interest rates go down for more than a generation. Interest rates started going down in 1920. They will continue to go down until just after World War II. Memory conditions expectations. Right? So here was General George C. Marshall preparing the world for a huge outlay of American funds in the interest of stabilizing and returning Europe to prosperity. At the time, Treasury yields were pegged. The Fed was sitting on Treasury yields much as it is today with a different technique, but it still was manipulating the Treasury market. The yield was about 2.25%. Wage and price controls from World War II were just coming off, and the inflation rate, if you please, was about 17%. So the world was sitting there taking these bonds at 2.25%, investing at 2.25%, when the debasement of the currency was running along at 17%. So what that incident tells, what that era reminds me, is that people can and do invest in the rear-view mirror. People can and do, especially in fixed income, focus entirely on what they have seen and not what the auguries say they may see. Not confronting risk and reward, but rather coasting on memory. That was what characterized that moment, and that, I submit, is a little what characterizes this moment.
What characterizes this moment for gold investors? I told my friend Kenny that I would ask you. He wants to know, what about gold? And if you don't like the current system of fiat money, do you have anything that would replace it?
Yeah, well, gold will replace it, and it should replace it. The gold standard was this exquisite system in which money and interest rates moves in such a way as to synchronize world balance of payments and to check the excessive issuance of credit. That is a little beside the point concerning gold as an investment. People want to know, people conflate the idea of an idealized gold standard with gold as an investment asset. Now, gold is not an investment asset. It is a speculation on a certain set of monetary outcomes, mainly on a chaotic set of monetary outcomes. Imagine the gold price being 1 divided by a number we'll call the world's faith in the institution of Ben S. Bernanke, Ph.D. That's the gold price. The gold price is now $1,300. it will yield as much at 900 as it does today at 1300. There's no conference call, there's no earnings, there's no price-book ratio, nothing. The gold price is a price. It is a concept. It's not an investment. So is it too high? Well, yes and no. I happen to be bullish on it because I think that the monetary system we have come to assume to be a permanent condition, this system is coming unstuck, in my opinion. That, too, is a form of stargazing.
Well, I know what happens when we assume. I'm going to leave it there. I want to thank you very much. Jim Grant, coming to us, Grant's Interest Rate Observer. Good luck with the conference in London, and good luck with the conference March 29th here in New York.